Let me now bring on board Sean Darby, Chief Global Equity Strategist with Jefferies. He joins us live from Hong Kong via Skype. Sean, morning. Thank you for joining us. Sean, the street is clearly divided on how one should read into the recent crack in commodities. The bulls are of the view that this is great news for markets like India and China, and firms like GMO and Morgan Stanley are of the view that a crack in commodity prices is some kind of an harbinger that in coming quarters we could be staring at poor global growth. What are your thoughts?
Well, good morning. I think it's very interesting about what's been happening in financial markets. Bear in mind that the consensus at the end of last year was that we would get a rotation out of fixed income into global equities. What ironically is happening is we're getting a rotation out of commodities into fixed income and equities. So there's been one real rug pulled under the carpet's been pulled under the investors' feet over the last 6 months because it's wrong-footed a lot of people. Number two, I would say that not only gold is being liquidated, it's a general liquidation of commodities, and it's related not only just to copper but also to agricultural commodities as well, which have seen a softening in prices given a much better outlook for planting. So I think the first thing to say is that it's a combination of factors: strong dollar, oversupply coming into areas such as copper and metals, and also an outlook change on some of the agricultural complex. And I think overall that people have been very overweight commodities in portfolios since '09, and I think we're going to still see liquidation of commodities going on through the whole of this year.
Sean, should we blame China? Is China for everything which is happening in industrial commodities? Because generally everyone is of the view that Chinese growth rate will plunge and that will have an impact on industrial commodity demand.
Well, I think it's very hard just to blame a single entity like China. I think it's been on the cards for some time that China's GDP numbers would be on the soft side, and even last year it was the lowest annualized GDP number for nearly 7 years. So I think the trouble has been is that you've had a significant sea change in sentiment on commodities, as I mentioned, with the fact that the biggest marginal buyer has also turned very, very soft in terms of its purchases. I think the bottom line here is that there's not really any evidence of anywhere else that's going to take up the slack in commodity demand, and the developed world is still seeing very, very sluggish growth. So underlying the theme, I think, is still the fact that commodity prices will be lower from here 6 months on, and that general inflation expectations may actually turn out to be a lot weaker than what was being priced into bond markets at the beginning of this year.
So, Sean, in that case, with correction in commodity prices, does a net commodity importer countries like India offer more value? What's your call? Because last week as well, we've shot up a fair bit.
Well, I think it's interesting because it's just really what equity investors buy into in India, and I still suspect equity investors buy into growth. I think the underlying features of current account and fiscal deficits probably only matter to FX and fixed income investors. So to answer your question, for the fixed income and FX investors, actually the changes in commodity prices probably augur very well for them over the next 3 to 6 months. There'll be improvements in the current account and equally on inflation expectations for India. On the earnings front for India, I think it's still a very mixed picture, and I think maybe it's too early to make big calls on the equity market from here. But I would take your point. I would agree with you that the changes in commodity prices make a very, very big impact for China and India. But whether in the short term that's just related to FX and fixed income flows rather than just equities, I think it's still the jury's out on that one.
So would you expect cheap valuations to be the primary driver of market returns rather than improved earnings when it comes to India in particular?
I think it's a fair answer. I think globally, there's not really any market that's showing outstanding earnings revisions, and even the US, as you've pointed out, has had a pretty lackluster first quarter earnings season. So what's happening now is that when we watch flows of money going into global equities, it seems to be very much on a discretionary valuation basis. So last year, the emerging markets saw relatively poor inflows compared to the developed markets because they traded on quite high valuations, and we're starting to see that perhaps now even itself out with valuations now moving up in the US and in Japan, meaning that I think there'll be some marginal flows into EM. So again, the bottom line here is that without really very much earnings visibility, people are really just asset allocating around valuation metrics.
Mm. Sean, are you a bit surprised with the outperformance in developed market equities this year? When we started the year, emerging market equities were trading at the top of the heap. Now emerging market equities have come down and developed market equities have made a comeback.
I am a little bit. I'm a little bit concerned now that some of the valuation stretch in developed markets is going to inhibit any new flows into their markets relative to EM. I think that at the end of last year there was an exhaustion phase on EM, particularly the fact that there wasn't really the same level of economic momentum in EM, and I think that's really what's unraveled in the last 3 to 4 months, that EM has not been able to deliver the GDP numbers that the investors had wanted. And people, as I said, unfortunately, are just using very simple valuation metrics. I think there's a comfort factor in that because, again, the visibility out there on growth is probably no more in terms of conviction than one quarter.
Sean, so at a time when most of the central bankers are committed to print money, where will money move now? Bonds are expensive, emerging market equities are not that cheap, developed markets we can endlessly argue whether they are attractive or not.
Well, I think it's a very good question, and it really is very open-ended. The first question is, of course, whether it's actually having any effectiveness on the general economy, this QE, and secondly, what's left out there for investors if indeed more central banks are adding to the liquidity pool. I think the first question is that what it has done is stabilize asset prices, and I think for the developed world that's been a very important feature of their economies over the last decade, and allowing asset prices to stabilize or clear has probably improved at least some of the consumer sentiment over the last couple of years. So in a sense, QE's worked by clearing asset markets and providing a benchmark for that in the global economy. Secondly, it's very, very difficult now to really believe that fixed income offers any attractive returns, and whether it's actually in corporate credit, junk, or indeed government bonds, the returns on yields now are so low that they're mitigated by the fact that inflation is already still eroding that value. So it leaves one with a view on equities, and I think the key here really is that you can still use a variety of investment styles like dividend yield, high ROEs, and provided you sort of have a reasonable view on terms of your trading outlook, you can actually buy into some groups of stocks within the global economy that ought to deliver at least modest single-digit returns. And I think that's the key. If you're investing in global equities at the moment, it's modest single-digit returns on an annualized basis over the next couple of years.
So, Sean, what happens to U.S. equities? Because while the emerging world is actually benefiting from the commodity crash, the U.S. markets aren't quite.
Well, it's a very interesting one. I think the commodity complex overall can provide a bit of a mixed picture in the short term. As we mentioned about India, it may actually deliver a lot of long-term benefits for India, but it may in the short term not necessarily be an uplift to profits. And I see the similar picture for the United States. This year, as I said, agricultural prices are likely to be on a much softer side, and equally, oil prices have also come off their highs. The interesting thing about the US and for developed markets is lower commodity prices provide a very, very nice disinflationary backdrop for consumption. And I think there is probably the benefits for the US in the longer term. And that's really what you saw in the early 1990s. You had a big bull market in the US, which benefited, frankly, from enormous low commodity prices and disinflation. And I think that would be an ideal backdrop for GDP numbers over the next couple of years. It may, in the short term, however, be more harmful for earnings numbers. And I think that's going to still be the drag on the equity markets in perhaps the short term.